Tax Foundation University, our third lecture. Today I'm going to be talking about international tax policy, and that word's very vague, but what I really mean is you look at countries and how they define what you would call their tax borders, or when they tax individuals and businesses when they earn income, whether it is overseas or here in the United States. And by the way, I'm Kyle Pomerleau. I'm an economist and director of the Center for Quantitative Analysis at the Tax Foundation. And as I was going to say, three main points here for this lecture. One, just what is international tax policy? I think we hear a lot about things like GILTI and FDII, which are weird jargon, confusing. And I'm going to start with the very basics about how to think about this stuff and then get more into the weeds about how different policies work. Then I'm going to talk about approaches to international tax policy. So how do countries set up their taxation of individuals and businesses? What are these general principles when you hear these words? What do they actually mean? And then lastly, I'll cap off with a brief overview of how the United States recently changed its international tax policy, part of the Tax Cuts and Jobs Act. So first, what is international tax policy? And as I mentioned before, it's how countries decide when and to what extent they tax corporations and individuals that are operating within their country. So I have a few examples up here of taxpayers to sort of walk through like why this is an important question, why this is an important issue. Example A, imagine an individual in the United States. He earns income from consulting services, so he's a consultant that contracts out to a firm that's in France, and they provide that business in France. Example 2, a US business produces widgets in the United States and sells them to a firm in the United Kingdom. These are two just general examples showing that these differences are important, and under certain systems, income would be taxed, and under others, income wouldn't be taxed. And just a final point before I jump in that is, when thinking about the way countries devise their tax borders, individuals and businesses are typically treated differently. That when we think of corporations, we think of this world of territorial worldwide, but on the side of the individual, we think about the idea of citizen-based versus residence-based and territorial taxation. So walking through this, you can't really perfectly compare the treatment of corporations and individuals in a strict sense. Three main approaches to international tax policy for individuals specifically. The first is citizen-based taxation, and this is similar to what the United States does, and that is all citizens of the United States, wherever they're located, wherever their income is located, is taxable in the United States. In addition, non-residents that operate in the United States are taxable on their worldwide income. Residence-based taxation, and this is the most common one, this is, under this system, all residents of a country. So if you're in the United States earning income, regardless of your citizenship, you can be a French citizen but a resident of the United States, all the income that you earn in the US would be taxable if we had a residence-based tax system. And then third one is territorial. Now we hear a lot about this with corporations, but it is also applicable in the individual sense. And under this system, works just like corporations. Individuals in a jurisdiction, so if the US had a territorial individual system, the US resident, regardless of their citizenship, again, if they earn income doing business in the United States, so they earn a wage from, say, working at McDonald's down the street, that would be taxable in the United States. But if they earned income from, say, consulting services in France, so they worked for a French firm, that income popped up in France and they earned it, that would be exempt from US taxation, as that income was actually earned outside of the territory, thus this territorial name. So let's think about an example here. So an individual in the United States earns income from consulting services that they provide to a business in France. So I kind of already gave this away a little bit, but thinking about this again, under a citizen-based tax system, of course, they're taxable. They're a US citizen, their income's being taxed by the United States, regardless of where they are, right? In this example, they're in the United States. Residents, same deal. This person is in the United States, they're gonna be taxable. But under a territorial tax system, not taxable. Again, this is income that's earned outside of the US, it's outside of the taxing jurisdiction of the United States under a territorial tax system. So you can see how these three principles of taxation line up in different ways for this single example here. And just a couple notes, and I mentioned this, but just to reiterate here, most countries use the resident principle to tax individuals. If you look across Europe, most of them are residence-based. French citizens aren't typically liable for French tax if they are living and earning all of their income abroad in, say, the United States or Canada. The United States uses a citizen-based tax system. This is, of course, a big complaint of those US citizens that currently live abroad. You've probably, if you're paying attention to the tax debate a little bit, you hear US citizens living abroad complaining about this extraterritorial taxation and the compliance costs that go with it that become very annoying for them. Because under the US system, because it's a citizen-based tax system, even if you're not liable for individual income tax operating, say, in Japan and earning income in Japan, you still have to file a tax return like you would if you were in the United States earning income, even if you weren't subject to tax. So thinking about this, there's an additional issue here over and above just paying tax. It's complying with the tax under the citizen-based system. And very few countries implement the territorial approach to individual taxation. I think in a short review of a few countries, I saw that there were just 2 countries that had territorial tax systems, just like there are 2 countries in the world that have citizen-based tax systems. And each approach has its pros and cons. I kind of mentioned the citizen-based tax system and its con, that it places an additional compliance burden on US citizens that are operating overseas. Well, if you think about the territorial system, that actually shifts the compliance burden onto the government to figure out, oh, you earn this dollar, is this dollar outside of our jurisdiction or inside of our jurisdiction? So you can see that's also a challenge, and that indicates why many countries have kept with or go with the residence-based system rather than either of the 2 extremes. Now on to corporate taxation and how to think about that. So just like individual taxation, there are 3 main approaches or 3 main principles to corporate taxation and how countries define when and where corporate profits are taxable. The first one, residence-based taxation. So this word, of course, is familiar, very similar to the use of the word on the individual side. But when we hear it in the tax debate, we actually hear the term worldwide. And that comes from the fact that if you are a resident, say, in the United States under a residence-based system, all income, the worldwide income of that corporation is taxable in the United States. So that's where that term worldwide comes from. And the last bit here is non-headquartered firms. It's not as though they are exempt from taxation in the United States when they operate here. They still have to pay tax in the United States on profits they earn here. But if you're not headquartered in the United States, you don't have to pay tax on profits you earn outside of the United States. The second one, a source-based tax, or what's commonly considered a territorial tax system. And under this system, all income of a corporations earned within a jurisdiction are taxed regardless of the headquarters of that country. So in contrast to, say, a worldwide tax system, under this system, headquarters really doesn't actually matter. What matters is the location of your profits. So if you're headquartered in France and you don't earn any profits in the United States, well, you're not going to be paying tax. But under a residence-based system, you may be paying tax if you're headquartered in the United States. Then the third one is a destination-based system. And this one is relatively new in the tax debate. And by new, I mean like 30 years old rather than these two classic ones, which are like 60 or 70 years old or maybe older. This one is based on the location of sales rather than profits. And I can go into that more if you guys have any questions at the end, but all income from corporations earned from selling in a jurisdiction, regardless of where the goods were produced or where the corporation is headquartered. And this may seem a little confusing compared to, say, the source-based tax system, but I'll get to an example to show why this distinction is very important. And destination-based systems, why it's kind of a new concept in the corporate tax world is because it's traditionally been thought of in the realm of sales taxes and value-added taxes. That under a value-added tax, you have to do basically the same thing and determine when goods are taxable in the jurisdiction. And under a value-added tax, a destination-based tax, just simply says that, you know, if the good is sold within the jurisdiction, regardless of where it came from, it's taxable in that jurisdiction. And this principle of corporate taxation borrows from that framework of the value-added tax. An example, just to parse this out a little bit from the very beginning, this example of a US multinational firm, so a firm that's headquartered in the United States, makes widgets in the United States, so the factory is actually located here, and then sells them to another firm in the United Kingdom. And that firm does whatever, who cares, with those widgets. And the US firm earns $100 in profits in the United States. So under the three systems, you know, when is this taxable? Well, under residence, this is taxable. The question you have to answer here is the first one. Is this a US multinational firm? The answer is yes. Well, the $100 of profits are taxable in the United States. Second system, source-based taxation. So where are those profits being earned? Well, under a source-based tax system, the factory is placed in the United States, the economic activity is in the United States, the sale originates from the United States, so the profits are sourced to the United States. So under a source-based taxation, you are taxable. But then the third one, destination-based system, is a little different. You can see it's not taxable. Well, what is the question you have to answer for a destination-based system? Well, the question has nothing to do with headquarters. It has nothing to do with the location of production. It all has to do with where those goods ultimately end up. So where are those goods going? Where are they being sold? Well, here, they're being sold to the United Kingdom. They're not being sold anywhere in the United States. So those profits that the company earns, the sales from that, are exempt from taxation in the United States. Now, under a destination-based system, thinking about this, flipping this in reverse just to make this a little bit clear about how it works holistically, is that, say the firm, everything was flipped about this transaction. It's a UK firm, a United Kingdom firm, the factory is in the United Kingdom, and the widgets are being sold into the United States. Well, under that, this would actually flip, where under residence and source, those wouldn't be taxed, but under a destination-based system, they would be taxed. those widgets coming into the United States would be subject to taxation, and that would be a revenue for the US government. And if the UK also had a destination-based system, then it would be exempt from taxation in the United Kingdom. Before I move on, I want to stop to see if anyone has any questions or wants any additional clarification before I jump in to some more details. Okay, good. So just to look at this more holistically here, so corporate taxes, they classically fall somewhere between residence and source-based taxation. The vast majority of developed nations lean closer to what you would call a source-based tax system, the taxation of corporations, not residence-based. The US tax system before the Tax Cuts and Jobs Act could be considered a residence-based tax system or a worldwide tax system. Under the previous system, US-based multinationals were subject to tax on their worldwide profits. They were able to defer additional taxation on their foreign profits as long as they kept them overseas. But at the end of the day, when profits were earned, eventually they'd be taxed by the United States. Other countries lean more towards the source-based tax system, where if a French multinational firm earned profits in Italy, those profits, for the most part, wouldn't be subject to French taxation. Now, when I say that these countries kind of lean closer to source, but they're never pure source, the reason I say that is because no system is pure in any sense, that all of these systems deviate in some way through rules and exceptions that sometimes subject profits to taxation, foreign profits to taxation when they're a source-based or a territorial-based system, whereas residence-based or worldwide systems sometimes exempt income when it's foreign and would theoretically be taxed. Now, the second point here is countries, and as I said, it's kind of new, countries are starting to consider destination-based taxation as a reasonable principle for corporate taxation rather than just value-added taxes. In the United States, back in 2016, the House GOP released what they called the blueprint, and under this system, they transformed the corporate tax into what was called a destination-based cash flow tax. And under that system, this is what was called the border adjustment. And that border adjustment was what moved the tax system from the worldwide system to the destination-based system. But the US is not the only one considering moving in the direction of destination-based taxes. The European Union, when we hear about its flirtations with the digital tax, this is a type of destination-based tax. What they're doing is they are, for any, say, US company, and there's reason to believe that the EU is looking at US companies mostly, US companies sell digital goods into Europe, they would be subject to this special 3% digital tax. Well, that sounds an awful lot like a destination-based system where a company sells widgets into a jurisdiction, those widgets are then taxed. Well, this is the same thing, except it's on intangible or digital products, something a little less obvious as a widget, but that's the direction that the European Union is heading in. Not in a comprehensive sense like the GOP blueprint, but more of a narrow, we're going to tax very specific large firms with digital presence in our jurisdictions. And the last one is what we'd call a diverted profits tax. And these are highly complex. I don't understand entirely how they work, but Australia and the United Kingdom have put together these taxes. Actually, if you know something about the new Tax Cuts and Jobs Act, base erosion and anti-avoidance tax, diverted profits taxes look very similar to that. That at some point, these taxes, what they're doing is they're bringing in deductible payments into the tax base. So if you're a country operating in the United Kingdom, and you import a lot of stuff, meaning you're deducting a lot of stuff against your taxable income, the diverted profits tax adds some of that back into your taxable income and effectively taxes those goods that you're bringing into the country, thus moving closer to that destination-based principle. Yeah.
I mentioned the 3% digital tax. Is that on the whole sale, or is there some reduction for cost?
Yeah, so like the traditional border adjustment, it is on the whole sale price, the whole revenue of the sale. So if you're selling a digital good and the sales price was $100, that it's 3% on the $100. It's not the profit on the $100, it's the full $100. And that's more in line with the destination-based principle. So wrapping up here, is talking about the Tax Cuts and Jobs Act and what that did to the way that the United States taxes foreign profits. So in general, I think it's fair to say that it made significant changes to the way that the US taxes foreign profits. Previous system, worldwide tax system with this idea of deferral, lots of interesting rules baked in there to prevent tax avoidance, but it was generally considered a really poor system for a number of reasons. One, it created a lot of behavioral distortions. Since a worldwide tax system is based on the residence of a corporation, well, one way that a company can avoid US taxation is to just move their residence elsewhere. So if you're a company based in the US and you have lots of sales, say in France, and you don't really want to pay US tax on those French profits, well, move your headquarters to Canada, and voila, you've eliminated the US tax on those foreign profits. So there was a big issue with that idea of inversions right there. So what did the GOP come up with through the Tax Cuts and Jobs Act? I'd say that it moved towards a territorial tax system or a source-based tax system with anti-base erosion provisions. And before I get into the details, why would they consider the setup just from a general standpoint is that one of the benefits of moving to a territorial tax system is you eliminate a lot of those behavioral problems with a worldwide system. So as I mentioned, the worldwide system encourages companies to move their headquarters elsewhere. Well, if you have a system that's indifferent to location of headquarters, then you've eliminated that incentive entirely. Well, there's a challenge, though, with a territorial tax system because, of course, in tax policy, there's no perfect solution to anything. There are always challenges and trade-offs. Well, moving to a territorial tax system introduces another possible distortion or possible challenge, and that's the issue of what's called profit shifting or base erosion. Under the previous system, if you were located in the United States and you earned profits in the United States, and the tax rate here was 35%, well, you had a general incentive to make your profits as low as possible in the United States and as high as possible elsewhere, because tax rates were generally lower elsewhere. So if you were successful in taking $100 of profits and moving it out of the United States and into the United Kingdom, well, you get the tax benefit of the differential between the 35% rate and I think at this point, 17% rate in the United Kingdom. Well, that was a concern with the worldwide system, but it wasn't a significant one because under a worldwide system, eventually all your profits, no matter where they're located, are taxed in the United States. It was still a problem, however, because companies could defer that tax liability as long as they left those profits overseas. But it wasn't that bad because there's this idea that, well, eventually those profits are going to have to come back to the United States and be distributed to shareholders because shareholders would like their returns on that neat investment that you did. Well, what if you move to a territorial tax system? What does that look like? Well, under a territorial tax system, you don't have that additional tax on foreign profits. So if a company earned $100 here in profits but ended up shifting it over to the United Kingdom, that's actually a permanent loss of federal tax revenue if companies are able to do that. Now, how do countries generally approach this? And I mentioned this very briefly, is that countries realize that this is a problem, and most European nations, while they have territorial tax systems that do exempt foreign profits, they pay close attention to what is called highly mobile income, or income that's easily shifted overseas. So if their rules determine, well, you've earned a lot of this highly mobile income in this low tax jurisdiction, we think that you've shifted profits out of our country, we're going to tax that just like if we had a worldwide tax system. So that was, I would say, the thought process here behind lawmakers when they were putting together the Tax Cuts and Jobs Act, that one, they wanted the territorial tax system, so they went in that direction, but they introduced these anti-base erosion provisions, and I'll get into them in detail here. So what are the four main components of the new tax law? First is what's called a participation exemption, and this is like very much in the world of tax jargon, but what this really is the exemption on foreign profits. So under the previous system, when a US company earned profits in the United Kingdom, those profits would eventually be paid back to the United States in the form of dividends. And under a worldwide system, those dividends are added to taxable income for the US company. That's how the US tax system operated to tax worldwide profits. Well, under a participation exemption, and sometimes often called a dividend deduction or a dividend exemption system, those dividends paid back from the United Kingdom to the US company in the United States are deducted against taxable income instead of added to taxable income. So they are effectively exempt from taxation here. The participation exemption has some rules attached to it to make sure that there's no gaming of it, but it's generally straightforward, just like most participation exemptions throughout the world. Profits paid back, exempt from taxation. Then these three additional pieces on top of the participation exemption, GILTI, FDII, and BEAT, these are what you would call the anti-base erosion provisions, that if you just stopped with the first one, that's going to the source-based tax, but then adding these three is what sort of deviates from the pure source-based tax and gets you to the hybrid system that we have today. So starting with GILTI, Global Intangible Low Tax Income. This is effectively a new definition of income that corporations have to add to taxable income every single year. And what this definition of income is aimed at is to provide what you would call a backstop to this territorial tax system, that foreign profits earned overseas have to face a minimum level of taxation in order to be exempt from this GILTI tax, effectively. That under GILTI, companies have to take into their taxable income every single year their foreign profits. And those profits are then subject effectively to a minimum tax of 10.5%. And if you, for more or less, and I know that there's some tricky exceptions to this, but more or less, if you pay a tax rate of 10%, you are exempt from US tax liability, but if you pay under that, you have to pay some additional tax to the United States. And GILTI mentions this idea of intangible income. Well, this isn't just a tax on all income earned overseas. Rather, it's a tax on a very specific subset of income, intangible income. Or the idea here is that companies are shifting what's called intellectual property offshore and using that intellectual property to avoid US tax liability and place those profits in low tax jurisdictions. Well, they have a formulaic approach to get to intellectual property, but that's what it's doing here. It's not a full tax on all the profits like previous system. It's a narrower tax on a specific subset of profits. Second piece here, FDII. This is another definition of income, and it's also intangible related, foreign derived intangible income. This is what you would kind of think of as the mirror image of GILTI. So what GILTI is doing is it's looking, say, at foreign profits that are located in foreign jurisdictions. So you're earning profits in Bermuda from intellectual property or something like that, and GILTI is going to capture that at a low tax rate of 10.5%. Well, FDII is the other way around, that if in the United States you have intellectual property that as a company you're using to sell products with, you effectively get a reduced tax rate of about, well, in this case, it's 13.125%, so a reduced tax rate there. So these two provisions or these two definitions of income work almost in concert to create a nearly level playing field for intellectual property income, whether a company places IP overseas or they place it here in the United States. One way to think about this is that the new tax system, thinking of the three pieces here, it's a territorial tax system for ordinary profits, and then it's a worldwide low tax system for intellectual property profits. So it's this hybrid approach where you have a worldwide piece on certain subset of income and a territorial piece on the rest of the income. Then the last piece, and I mentioned this, is the BEAT, base erosion anti-avoidance tax or anti-abuse tax. This tax is effectively a new alternative minimum tax for corporations that sell a lot of goods overseas. So if you're a company located here and you purchase a lot of goods from foreign companies, so say you build cars here and you purchase a lot of parts from overseas and you're deducting a lot of payments from those parts, and you wipe out your tax liability here in the United States because you're deducting so much, it's a possibility that this tax hits you. Because what this tax does is it requires companies to do an alternative measure or an alternative calculation of taxable income, where they get rid of all these deductions you made for purchases from goods overseas and then tax that at a low rate. And getting back to this, or sorry, skipping ahead a little bit. And there are a bunch of exceptions to the GILTI and how it works. Not worth getting into unless you want to talk to me after. But generally what this tax is doing is it's trying to prevent companies from deducting a lot of payments here, deducting a lot of costs here in order to reduce their profits in the United States, under the idea that, well, those profits are going to show up in some other jurisdiction, and that's a loss in revenue to the United States. That's profit shifting. That's base erosion. And just my last point here, wrapping up, the new tax system under the Tax Cuts and Jobs Act can be best understood as a hybrid system, not really a territorial system, not really a worldwide system. Rather, it's a mix of territorial, worldwide, and destination-based, where going from top to bottom here of the four provisions, the participation exemption, that's eliminating the tax on foreign profits. Yes, that's moving to a territorial system. But then GILTI and FDII, those two definitions are creating this worldwide tax on intangible income. Well, that's more in line with this residence-based system, because under those systems, or under these definitions of income, or rather under the new tax code, only US companies, US-based multinationals have to calculate GILTI and FDII. It's based on residence. So if your residence here, you're subject to GILTI and FDII, whereas if you're based in Switzerland, you're not. And then the BEAT, well, what is this doing? Well, if companies are paying for goods from overseas, importing lots of car parts that they're going to use to build Fords and then sell into the US market, well, that's effectively a tax on goods coming into the United States, and that's very much in line with what you would call a destination-based system. So that's, I hope that's a good brief overview of how to think about the Tax Cuts and Jobs Act, but also just in general, how to think about international taxation and how it works in the world. And with that, thank you, and if you have any questions, feel free to ask. I will answer. Steve.
There was an early concern when this all started up that people could redefine things to be intellectual property. And so they switched to this approach, which is a formula. And if your income is artificially high, low cost, get hit.
Yes.
There are a few things that aren't intellectual property that happen to earn a high return because either the product is very popular or easy to produce or something. So CRS has kept saying, well, this is a formulaic approach, and sometimes there's a spillover into other types of production that does come under it. Do you agree with their analysis of it?
I do agree with that. So Congressional Research Service had a great long overview of the new international tax rules. And the idea that Steve is getting at here is that if you're going to go after a subset of income, at the end of the day, you need to define what that income is, where in the world it's coming from. And Steve mentioned two general approaches. Well, one, you can go with a facts and circumstances approach where the company says to the IRS, look here, this is intellectual property, and this is not, tax it based on the rules. Or you can go with what's called a formulaic approach, where instead of defining IP based on the facts or circumstances of the actual transactions, instead you use a formula. And the formula they went with was this idea that intellectual property, when it earns profits, it earns what's called supernormal returns or above normal returns. And that if a company has, say, a factory overseas and it's earning a, say, 15% return on that factory, instead of asking the company nicely, do you have any intellectual property hiding over there? Instead, the system uses a formula saying, well, I see your factory and I see your profits. Your profits are about a 15% return, and I think that normal returns would be 10%. So 5% will be considered your intellectual property income, and that's what's going to be captured under GILTI. Well, Steve mentioned that under a formulaic approach, it may be simple and the company doesn't have to haggle with the IRS over what the definition of IP is. Well, the downside is it may capture the returns of things that aren't really intellectual property. That who's to say 10% is the right return? Perhaps that factory just earns 15% because it's a really great factory, it doesn't really have to do with intellectual property. Yeah.
Which of the three approaches for corporate taxation do you think is more efficient to bring more investment to the United States?
So I think that international tax policy probably has some to do with bringing investment to the United States, but I don't think it's as powerful as, say, domestic tax policies, such as expensing or reduced rate on profits here in the United States. Because if you think about the worldwide tax system, I mean, you're subjecting the foreign investment of U.S. firms. Yes, that's probably going to have an effect on investment in the United States. After all, what we end up sending overseas as investment is actually just mechanically our exports. So there's an interaction there, but I don't think it's a huge one. I think the pros and cons of each approach have to do with thinking about the behavior of companies and what's more efficient from that standpoint. And certainly in the traditional sense of, what's the best between residence and source. I mean, again, it's a trade-off. Residence system has this issue of inversions where companies want to move their headquarters overseas. Source has this issue of profit shifting, that it's really hard at times to really locate the source of profits, that companies they produce things all over the world, sprawling across the globe, and who's to say that it's $100 rather than 90 or 95 in the United States. Now, destination-based taxation avoids those issues. It actually has really nice properties in terms of behavior, that you don't have to define where the profits are located. You don't really have to define where the company's headquarters is located, all of that stuff. But the downside with destination-based system is it's relatively new in the arena of corporate taxation. And while it's worked very well in the realm of the value-added tax, I think there are political obstacles with destination-based systems, as we saw with the GOP blueprint and the debate there, that companies didn't see it the way that economists saw it. But I think economically there are virtues there. Great. Thank you very much.